With me today in the studio, I have Seb Patel, COO and co-founder at Franc. And today we are going to be talking about investment strategies. How do you approach investing? What investments do you need to have? What mix of funds? At what time? What time frames? What timelines?
Yeah, so fundamentally it's how and where you invest your money. So in terms of like how aggressive or conservative you want to be, and then that'll dictate into what actual assets you invest.
What would an investment strategy look like practically? Say I'm in my early 20s, I'm about to start a job, I need to invest for my retirement.
You potentially would have a different investment strategy for different goals. For a long-term goal like retirement, you should be heavily invested in equities, which is invested in the stock market, whether that's a combination of local and offshore equities.
I'm keen to know what your investment strategy has been.
I think the key thing was to start.
Welcome back to another episode of Frankly Speaking, where we speak frankly about investing and managing your money with a no-jargon approach. My name is Cassidy Nydahl. I'm head of growth at Franc, an investment app that's making investing simple and accessible to everyone. If you want to hear more about what we do, check out the description box below. And if you like what you see or hear, please give us a like, leave us a comment, and subscribe for future episodes. With me today in the studio, I have Seb Patel, COO and co-founder at Franc.
How's it, guys?
Nice to see you again in the studio.
Nice.
And today we are going to be talking about investment strategies. And it's a really important, really exciting topic because that's where all your investing starts. How do you approach investing? What investments do you need to have? What mix of funds? At what time? What time frames? What timelines? It really all starts with your investment strategy. So we're going to talk about what an investment strategy actually is. We're going to break down a few investment strategies that top investors have adopted over the years to earn their wealth. And then at the end, I'm going to ask Seb to spill the beans about his own investment strategy. I'm very curious myself to find out what you've invested and how over the years. And hopefully by the end of this, you'll be able to build your own investment strategy as well. My first question, obviously, just to kind of start us all off and set the context, what actually is an investment strategy?
Yeah, so fundamentally it's how and where you invest your money. So in terms of like how aggressive or conservative you want to be, and then that'll dictate into what actual assets you invest. And then, the one in terms of like how conservative and aggressive, it depends on either like your time horizon that you have, or could it even depend on your personality, right? Because even if, you should be investing aggressively because you've got like 20 years to invest, some people can't handle or stomach the stock market, right? So they want to keep their money safe, but it's maybe not the right thing to do from like building wealth perspective, but it helps them sleep better at night. So yeah, there's a few things that go into it, but it's effectively how you invest your money and what you invest into.
Okay, and we're going to go into those factors just now. But maybe before we do that, I think just to bring it to life for our audience, what would an investment strategy look like practically? So for example, let's say I'm in my early 20s, I'm about to start a job, I need to invest for my retirement, and I also have an overseas trip coming up in the next few years. What would that investment strategy look like?
Yeah, so it's a good thing that you gave two different examples, because you potentially would have a different investment strategy for different goals, right? So retirement is many years in the future. Generally, your investment strategy there should be more aggressive, because that you can ride the ups and downs of the stock market. So for a long-term goal like retirement, you should be heavily invested in equities, which is invested in the stock market, whether that's a combination of local and offshore equities. Whereas if you're saving towards a holiday in a couple of years, you don't have the luxury of that much time. So you want to invest in something that will earn you a decent return but not be volatile, right? So that when you need to withdraw that money in 18 months time or 24 months time or whatever it is, it's not a bad time to withdraw, because when you need to pay for flights and accommodation, you need to pay for it. So yeah, it depends on your time horizon. It depends on what you're trying to do. But yes, to answer the second question on the holiday, it should be invested in like a money market fund. That would be more suitable.
So that brings me to the next question. You've kind of already touched on that. What are the factors that you need to be thinking about when you're putting your investment strategy together? Time horizon very much has come front and center. Are there any others that we need to be thinking about when we're putting our investment strategy together?
Yeah, so the one thing is like the psychology, your like innate risk tolerance. Do you understand the stock market is going to go up and down, or are you going to panic and as soon as there's something that goes wrong, withdraw, right? Because you know it's all good and well to say you need to invest for the long term and the stock market's going to go up and down, but when you see that minus 10% on your portfolio, you're like, are you going to be able to handle it and just say, ugh, it's another day, you know, I can keep rolling with it, because that's very important. You know, there's no point in like kidding yourself and saying I can handle it, and then when something bad does happen, you panic. Like just to put a practical example, you know, when COVID hit, the like stock markets around the world like crashed, but very soon they were much higher than you know what they were before COVID, and you know there's no guarantee to say that it'll always happen, but stock markets, you know, over the last 100 odd years have shown that they you know are the best way for you
Yeah.
to build your wealth. I mean there are other ways like property and stuff, but those also have different issues. But yeah,
Cool. Any other factors? I mean, top of mind that I can think of is also obviously your family situation. If you have a child, I'm assuming your investment strategy changes somewhat as well.
to some extent. I mean, if you've got a like a sub goal for your child, to, you know, for their education, that might dictate part of your investment strategy. Yeah, the other things are maybe like how much debt you have. You know, should you be investing in the first place or rather paying off debt? Maybe that's a slightly different consideration. But I mean, yeah, maybe you know how secure your job is. Have you got your emergency fund? Yeah, all those kinds of things.
Okay. So we've kind of gone over some of the factors that you need to think about. But when we are practically wanting to actually build our investment strategy, what would you say is that first step to, or first thing you need to think about to put that in place?
I think we mentioned before, but it's what you're trying to achieve. Like what is your goal? Are you trying to create a one size fits all investment strategy? Because then that's going to be difficult. But if you can like compartmentalize each goal, so that your strategy can be appropriate, you know, and like I said, the common ones would be retirement, where you know you can be very aggressive and invest into equities. Is the other one an emergency fund where you need to be more conservative and be able to access your money? Is there something in between, like saving up for a deposit for a home, which is maybe only 5 or 6 years away? Is there, you know, your child's education, which could be 15 years away? You know, yeah, I would think it's just like to try and understand what you're trying to achieve, what the goal is, and then you know that can help dictate how to structure your investment strategy.
And almost work backwards from there, right? So understanding like how much my child might need when they go into tertiary education. How much do I need to be investing now to get to that point? I guess I'm also just thinking practically, say I only have 500 Rand to invest every month, right? Splitting it between all these different goals seems a little bit like you're diluting the impact of your money. So in those cases, I mean, the simplest version of an investment strategy, what would you recommend there?
Yeah, I mean, if you've only got a little bit of money, I think then you look to maybe prioritize what you should be doing first. And I think the most important thing then to start off with is like build your emergency fund so that you know you've got that safety net. And then once that's done, you know, you don't need to add to it unless there are emergencies and you have to start pulling money from it. But yeah, once your emergency fund is done, then effectively start contributing more and more into equities so that you can start building your wealth. Whether then that's for retirement or whether that's for an education goal or whether that's for a house deposit, it could be used for a number of different things. But yeah, once your emergency fund is sorted, then just make sure that you're getting that equity exposure. And I mean, why equity exposure is important because, you know, over the last how many years, the stock market is generally, you know, given you a 10 to 15% return. Sometimes it's, you know, minus 20, sometimes it's plus 40, you know, so that's what you need to be comfortable with the volatility. But when you look at it from a long period of time, it kind of gives you sort of 10 to 15% return, which, you know, is important because inflation is, let's say, 6%. So, you know, you're beating inflation and you're actually growing your money.
Earlier, you spoke about aggressive versus conservative investing. And I think those are obviously two key terms that I see come up a lot when it comes to investment strategies. Maybe you can unpack what both of those really mean in terms of investment strategies.
Yeah, so again, it goes to like maybe the psychology of it, but if you're conservative, that means you don't want to take a lot of risk, and it could be just because you don't want to take risk, or just be because your time horizon is short and you shouldn't be taking risk. So yeah, if you're conservative, it's more likely that you'll be investing in a cash product, a money market product, maybe a bond product, where the risk of your capital, of losing any capital, is very low. But with that comes a trade-off that the return might not be very high. So they always say, the higher the risk, the higher the potential return. So here you're reducing your risk, but then you're also reducing your potential return. If you're aggressive, it could be just because you're speculative, or it's because you have the time to kind of like play the long game. And that means that you invested in assets that can produce you a higher return, but then comes the higher risk. So you need to be able to withstand the ups and downs of the stock market, of the cryptocurrency that you invested in. Sometimes property can also be quite speculative, depending on what you like, the price that you came in at.
So I was going to ask, at what points in your life should you, because I understand that it's obviously based on your psychology in some ways, but I can imagine it's also based on your age and where you're at in your life and how close you are potentially to your goals. So I don't know if you want to speak to that. If I had a high risk tolerance, there are probably times when I should be more aggressive or more conservative, right?
Yeah. So, I mean, strictly speaking, the younger you are, the more aggressive you can be. The older you are, the less aggressive you can be, just because you don't have that much time to ride out the ups and downs of the stock markets. But you also need to take into account, I mean, some like retirement fund strategies, as you get closer to retirement, they reduce the amount of equity in your portfolio. So let's say you're 40, they say, okay, this person's still got 20 or 30 years before they retire. We're happy to give them the full equity allocation. When they're 50, they're like, okay, it's 10 years less, let's reduce it. When they're 60, let's reduce it more. That has its benefits, to the extent like something bad happens in the stock market, so that you're protected. And I think it was more important previously, where people retired and then they had their like pension lump sum, and that they had to do something with it, right? I mean, if the stock market crashed the day before you retired, then your 100 that you would have got is now only 85, and that's a huge thing, because you would have had to buy a pension with that 85. It works a bit differently now, but I mean, I can also get into that. But what we also need to consider is that, okay, someone's now retiring at 65, they probably still got another 20 or 30 years to live, and people are living longer, as we know. So that 20 or 30 years is also a long time to be invested in the stock market. So I think the mentality that we had previously of people as they get older should be reducing their exposure to the stock market, I think is less relevant now, because people are living for so much longer. Because you also don't want to be like having been weaned off the stock market, and then all of a sudden the 100 that you could have, or that you are getting, should have been 120, because you've missed out. So it's kind of swings and roundabouts, but I think now like people are like still being aggressive as they retire, because they know that they've got still a lot of time to play with, if they are healthy. And the other thing is that previously, when you retired, people put their money and they effectively bought a pension, and the things that you could do with your pension were pretty limited. Now with things like a living annuity, you effectively, you don't buy a pension, you effectively keep living off your retirement money. So that, let's say you got 100, you're not using that to buy an income stream of like 2 every year or 5 every year, whatever the income stream is. You're actually saying, okay, I'm going to live off this 100 myself, which means that, if it keeps growing well, the pot that you have to live off is a lot higher.
Okay, so we've obviously established the foundations of investment strategy, what goes into it, what you should be thinking about, potentially at different ages, what you should be putting into that investment strategy. Some people might, watch this or listen to this and think, I don't even know where to start. In which case, a lot of people might advise a financial advisor to help you with your investment strategy. What is your take on that? Is that a good idea to, see someone chat through your suggested strategy or where you're at in your life with your goals and your financial situation, and kind of map out this strategy or plan for your finances?
I mean, I think talking to an advisor is a good place to start. I think you need to do your research, though, a bit of research to understand what you should be getting out of the advisor in terms of advice. I mean, a good advisor will give you good advice, a bad advisor will give you bad advice, like anything, So yeah, just make sure that you do research, that you can kind of like sniff out, like, is this a good or bad advisor? And yeah, look at the fees of the products that they are suggesting and whether they seem appropriate. Are they sort of suggesting an equity fund for an emergency fund? That does make sense. There's a lot of things you can do pretty quickly to figure that out.
And in the case of Franc, we obviously have a robo-advisor. I mean, how would you compare, using a robo-advisor for your investment strategy versus using a financial advisor? How do those two maybe fit in?
Yeah, a financial advisor would give you a much more holistic view. Like our robo-advisor just deals with the investment part of it. If you've got insurance needs or medical aid, healthcare needs, that kind of stuff, an advisor can help with that. Okay. Whereas ours will just give you kind of the core concepts that you can focus on from an investment perspective. I mean, I think the three products that we have, good enough for like 99% of people to start investing. You've got your money market fund, which you can, for emergencies. You've got the two equity funds, which is, for longer term investing. That's kind of all you need. But yeah, if you want to get a bit more complex, or if your needs are a bit more, then an advisor could help with that.
Now we're going to get to the good part. So I'm keen to know what your investment strategy has been and how that's changed over the years.
Yeah, so I think the key thing was to start as soon as I started earning an income. So as soon as I left university, the first job I had, I was contributing into two different products. The one was an RA, which when I look at it now, the idea was right, but the execution was bad. And that was also my advisor's fault, because I look at it now and the fees are crazy on that product. And how it works with these types of things is that the advisor gets like a bit of a lump sum upfront, and then effectively, if you want to like extract yourself from the RA, there's like a penalty that you need to pay because the insurance company has already paid the advisor the lump sum. So yeah, so it's not, if you look at it, you're like, okay, I've got, let's say 100 here, but if I want to move it to a different RA, I'm only going to get 85. And then you're like, well, is that worth it? And that's, that wasn't a great experience. Also, I mean, again, with that product, so I had the RA. I also, the same advisor put me into another product, which is an endowment product, which was also the wrong product, because endowments are only suitable to the extent your marginal rate is higher than 30%. And mine was not the first time I started investing, but at least they were in, unit trust investments that did well. Okay. So yeah, I mean, I contributed into those products for the first 5 years, and I got a lump sum. But then as I started earning more, I just started contributing directly into unit trust. Those, I mean, that's sort of like 15, 18 years ago. Like the low cost ETFs that we have now weren't around. So like, yeah, or weren't as common. Yeah. I think like the trend towards passive investments, which those have really become a lot more popular in the last, let's say, 5 to 10 years. So then I went with the kind of like brand names that a lot of people know, and I put it into unit trusts, balance funds, equity funds, and the like. And then so I did that for a long time. Then because I've always been in the investment space, and my last job, you have got more exposure to companies and listed companies. You're always looking at different businesses, so you understand the market a bit more. So that's when I kind of like started buying stocks directly as well. I've hardly sold any of them. I kind of like what I bought, I've sat on them. A few I've sold, but yeah, not a lot of them. So kind of just gone with like the buy and hold kind of strategy. And as ETFs have become more available, I've added that onto that basket, I guess. So yeah, at the moment it's a combination of unit trust, ETFs, direct stocks, and that was only just because like I kind of knew what was happening in the market, which stocks I should be buying. I haven't bought like new stocks in a long time just because I'm not as close to it as I used to be. So now I'm just putting it into like ETFs.
So it sounds like you had a bit of a rocky start then. Would you have done it differently in your first few years of I guess earning an income?
Yeah, I mean, I think that the intentions were right, just the advice was bad. So the rocky start wasn't really my fault. But I mean that's the problem sometimes with bad advisors. So I think if I would have done it differently, I might have just gone directly to the like the fund manager and effectively opened the account directly. But yeah, I mean it was 20 odd years ago, things were still quite paper based then. You didn't maybe have the same online platforms that you had now.
Thank you for sharing. That was really interesting. And thank you everyone for listening. If you have an investment strategy, we'd love to know what your investment strategy is, if something's worked for you, if it hasn't worked for you. We're really keen to hear your feedback and your stories. And if you have any other questions that you'd like to ask us for us to address in these Frankly Speaking episodes, please let us know. And make sure that you like and comment and subscribe for future episodes because we'd love to have you back. That's us for now. Cheers.